Merry Christmas, Emily.
Dan, it's the first week of December.
'Tis the season. What are we talking about today?
Roth conversions and end year tax strategy, year end holiday budgets and goals, and more of a semi personal, semi professional question: how do you spend your time at the end of the year as a financial planner?
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, so it's all about the end of the year. So this is really more of a New Year's episode, but we'll take it. We'll take it. 'Tis the season. So Roth conversions. What do we want to know?
Well, that's obviously one of the main things we talk about towards the end of the year here. And I do feel like it's a topic a lot of people don't know a lot about. It can be very complicated and very intimidating to start looking into yourself if you don't know anything about it. So I thought we'd go over some of the basics with people. First of all, how late in the year can you even do that? When do you need to start looking into that process?
So the literal answer is you can do this up to midnight on New Year's Eve. The practical answer is that you should probably be getting this done sometime in early December to make sure you've got a decent bit of runway. You can technically do it at any time during a calendar year, but the day of the conversion is where you put the pin in the tax ramifications of that decision.
Right. Well, what happens if you don't get them done in time? What are the ramifications of that?
It's not that there's ramifications so much as just, when did you want this to happen for tax planning purposes? Typically speaking, we're trying to plan for the current year in the sense that we're trying to kind of land at a particular level of taxable income and tax liability and so on. So if we miss it, let's say we submit paperwork on December 29th and it just doesn't get processed in time and they do it on January 5th or something, even though we submitted it earlier, it's the actual conversion that becomes the taxable event. And so that means that whatever we were planning on having happen in the current tax year is going to end up happening in the next tax year. And that may or may not be a big impact, but particularly for some folks who have really big pre-tax retirement account balances, you may be trying to shovel, tens of thousands or even hundreds of thousands of dollars across the tax line every year before you reach a certain point. And the value of everything in finance is time derived. So, if we do something earlier, the benefits or the harms of that thing are magnified over time versus if we do them later.
Can you talk a little bit about then why you don't just do them much earlier in the year? Why do we wait towards the end of the year to even kind of start looking at it for most people?
This is not so much of a hard and fast question as it is a what risks are we trying to hedge against question, because there's a good argument to be made about doing it early in the year. The argument to do Roth conversions earlier in the year is that we generally assume in any given year that we're expecting an upward market trajectory. Now, that doesn't happen every year, but that's the assumption. So the idea then would be, okay, if I think my assets are going to be worth more in December than they were in the prior January, then I should do my conversions in January because I then get to convert more of my money as a percentage basis before my money grows all year. And therefore, I'm getting more of my money converted as a percentage. And therefore, I'm getting there faster or I'm getting it done faster. And then all the growth from that money that was converted at the beginning of the year is going to be tax-free instead of being part of that pre-tax pool. So that's the argument for doing it earlier in the year. However, the problem that creates is that we have now presupposed a very specific amount of income for the year, and we've inserted a chunk of income at the beginning of the year. So let's say I convert $50,000 this year because I was assuming my income was going to be low enough that if I had a certain level of income from Social Security, pensions, maybe one of the spouses is still working, whatever the case is, and we were going to stay below the top of the 22% tax bracket based on their income and based on this, let's say $50,000 conversion I did in January. The problem that could emerge is, let's say somebody passes away and leaves you some money. Yay. That would be tax-free, except for certain assets are not inherited tax-free. For example, the benefit from non-qualified annuities can be subject to income tax. And if it's subject to income tax, it's increasing our taxable income as part of the inheritance and could accidentally push us over the tax line. Now, getting pushed over the tax line isn't the worst thing on earth, but there could be other downstream impacts like impacts to Medicare premium surcharges, whether we have to pay net investment income tax on our non-retirement savings, all sorts of stuff. So our philosophy of trying to do Roth conversions closer to the end of the year largely derives from having a much more accurate picture of your tax situation by December versus from January we can project, but there's a lot of unknowns. Whereas in December, there's still some unknowns, right? Somebody could die and leave you money, or something could happen, December 29th or something. But by the first or second week of December, we've got a pretty good fix on where your income should be for the year. And that lets us be more judicious in how much Roth conversion we're doing to potentially avoid the issue of going into different tax brackets or increasing your Medicare premium costs or anything like that.
Hmm. Well, there are instances, though, where we do intentionally kind of push people up into the next tax bracket because it does make more sense, right?
Yeah, I mean, that can happen. I think the circumstances there typically are derived from either the jump being really nominal, so let's say 10% to 12%, or 22% to 24%. There has been some concern over the last several years about the Tax Cuts and Jobs Act expiring, where we're all going to see tax bracket jumps at the end of 2025 unless they continue or extend or create new tax cuts of some sort by then, which now with the election is sort of anticipated but not guaranteed. But in that particular context, sometimes you go like, look, going up one more bracket's only going to cost us 2% more on that, and we can convert another, $130,000 or something, and that's worth it. So it becomes fact and circumstances dependent. One of the big things about Roth conversions is that we're doing this on the presupposition that we would like to have more tax-free income over a lifetime. And if we're doing these conversions early enough in our lifetime and we're living long enough, the benefits are usually pretty tangible. But at the same time, let's say you are expecting not to live past 75 because everybody in your family seems to pass away by 75, long history of heart disease or cancer, Lou Gehrig's, or any sort of things that tend to pop up at certain ages for some people, particularly based on genetic legacy. Well, in those cases, then you might look at it and say, well, yes, you're telling me that if I live to 80 or 85, the benefits of the Roth conversion are in the hundreds of thousands or millions of dollars, but I don't think I'm going to live that long. So then in those scenarios, either I need to do it faster or it isn't worth doing at all because I don't think I'm going to live long enough to recognize the benefits.
Right. Well, who else? I mean, other than the medical and genetic stuff we just went over, who else should be doing Roth conversions? How do you know if they're right for you?
So realistically, this sort of comes back to the question of where we are in the hierarchy of tax brackets. I tend to draw the line for Roth contributions to retirement plans, like Roth 401ks, Roth 403bs, et cetera, versus pre-tax at the 24% tax bracket. I think if we are at the 32% bracket or higher, we get into a scenario where like taxes could be higher in the future, but you're already so far up in the tax brackets that it's sort of hard to envision a strong return on doing conversions up there. But if we're in, let's say, the 10%, the 12%, even the 22%, and jumping from 12 to 22 is a big jump, but I can still see a case for converting all the way through the 22, even if you were currently in the 12. It just depends again on that, how long we have to recoup the costs and all of that factor. But the idea here is essentially, hey, I'm in low enough tax brackets that it's going to cost me less to recognize the income now that would cost me to recognize the income later. Or, and this is probably the biggest driver for Roth conversions in my practice, we're really looking at your RMD schedule and the growth of your pre-tax assets. And there's a scenario in which at a certain age, your RMDs are going to get so big, right? These required minimum distributions are going to grow to such a size that you are going to be forced through tax brackets, right? You're going to go from the 22 to the 24 to the 32 because the RMDs are getting bigger and bigger and bigger, where we're better off trying to hedge that down by paying the taxes earlier, getting more money over to the after-tax, tax-free side of our tax treatment buckets, and just eating the taxes today because the future taxes are enormous. So to give you an example, quite often if we're looking at a client who has something like, let's say, $1 million in pre-tax retirement money, a series of Roth conversions may show something like several hundred thousand or even over $1 million of tax savings over a lifetime. So bear in mind, we're not saving a bunch of taxes today. We're not, reaping these rewards, but over a 25, 30, 35, 40-year retirement, depending on how early they've retired and how long they may live, we may save ourselves hundreds of thousands of dollars, but it's probably going to take over a decade to start recognizing those benefits in a real sense.
Hmm. I guess it just highlights the importance of financial planning when you have enough runway left to be able to implement all of these things.
Well, I mean, even for, let's say, in an estate scenario, let's say somebody is 87 years old and their spouse has already passed away and they're like, hey, I'm not long for this world, but I'm starting to think about what I'm leaving behind. There are reasons you might decide to do conversions, even if you're not personally going to see the benefit. If you're, let's say, an 87-year-old person and you have a single child who's going to inherit all of your money, and your child is a successful doctor or lawyer, and you know that they're in like the 35, 37% tax brackets, but you're retired and you're living on Social Security and you're living in the 10% bracket pretty much all the time, or maybe the 12% bracket, there's an argument here to just say, hey, I'm going to leave you this money soon. I'm going to go ahead and recognize income in my 10 or 12% bracket. So you, my successful son or daughter, don't have to recognize the taxes in the 30+% brackets. So I mean, there's even reasons where it's not about us; it's about our family or our legacy, where these types of conversions can still make sense, where we may not see the benefit, but our family is going to see the benefit.
Right. Again, I suppose the importance of planning and thinking of everything, and why we do estate planning with people as well.
I mean, everything integrates with everything else. So Roth conversions go hand in hand with decisions about when to take Social Security, when to claim pensions, what age we're retiring at versus just being work optional at, but continuing to work, impacts to Medicare, impacts to gifts, college tuition. That's the biggest thing about financial planning. Everything affects everything else. So Roth conversions are a popular strategy because it's sort of easy to draw out the potential benefits, and sometimes the benefits can be enormous, but it's always facts and circumstances dependent. I highly advise anybody who is listening to this thinking about doing Roth conversions, because they're excited to listen to this, that they listen to the disclaimer at the end of every episode that says, please consult your certified financial planner, your tax professionals, and so on, to make sure that the amount of any Roth conversion you might do is the right amount for you to do this year, and further, that it is actually beneficial to you or your estate to do it based on the timeline available to you. Because there's also some other complicating factors about whether we want to do, let's say, backdoor Roth contributions versus Roth conversions, whether we're doing mega backdoor stuff. That's a whole second set of topics. But Roth conversions are a strategy, a powerful strategy potentially, but a complex one that can have negative ramifications if we're not doing it correctly.
A very fair warning. Speaking of, I'm going to jump to our second topic, my second question for you. As we're kind of getting into the end of the year now, obviously people are starting to do Christmas shopping or planning vacations as they have time off, etc. But it's incredibly important that people kind of stick to their budget or their goals, as it always is. But I do see that this time of year is such a really difficult time to do that. It's very difficult to rein in spending in December for people. But this is also the time of year where you can be, maxing out contributions to retirement accounts and whatever you have, or your HSA or anything like that. How can we assist people with doing that when it is so very tempting to spend in December and be generous with our families or go on trips to really stick to our budgets?
I think functionally the best answer to this is that it should have already been baked into the budgets, right? When we ask our clients for their cash flow and we look at their spending and so on, we ask about Christmas, we ask about vacations, we ask about birthdays and anniversaries and holidays and so on. And with that, that's often a healthy benchmark. And the trick is, as human beings, quite often we're just going to do the thing. Right? Like every year I think to myself, I really probably don't need to spend more than a couple $100 on gifts for Christmas. And then I see what I want to buy my wife, my parents, my family, etc., and I go do it. And I don't actually pay much attention to how much I'm spending. I think for a lot of people, the best thing here is to really have a family conversation, right? If we're thinking about our spouse or our kids, that sort of thing, to say, hey, what's the most important to us? What's the most meaningful thing to us? Does everybody here want an Xbox? Is that the kind of family we are? Is that the kind of gifting we're looking for? Or would we all rather take a trip to Mexico and spend a week somewhere nice? I think sometimes we pigeonhole ourselves into an expectation that, well, it's Christmas or it's Hanukkah, we've got to get presents under the tree, under the menorah, whatever it is, whatever we're celebrating. We've got to have shiny paper boxes, and we want to do this other stuff as well. But the truth is, gifts can be experiences. We don't have to give tangible things. And that's sort of a cultural thing that we're ingrained with sometimes. But I think to your question of how we manage the year-end costs, the budget, all of that, the best thing is to plan for it in advance, number one. And then number two, enjoy it kind of on a guilt-free basis as long as it's not destructive. So if we're better off taking a trip instead of giving a lot of gifts, great. If we're better off giving a lot of gifts and not, taking any vacations, whatever it is, that's fine. Because something that we talk to a lot of clients about at this time of year is, hey, you contributed 17,000 to your 401k this year. You've got 2 paychecks left this year. You could potentially defer 23,000. So if we've got it in the cash flow, and we've got the reserves in place to take care of it, it'd make a lot of sense to try to put another $3,000 in per paycheck for the last 2 paychecks of the year to max out that 401k. And that's wonderful. That's potentially very beneficial from a tax standpoint, retirement planning standpoint, but life is meant to be lived. So we want to strike a healthy balance between, those end of year, last minute contributions to this, that, or the other, and also making sure that we still enjoy the quality time that we have with our spouses, with our children, with our families, and so on.
What about when you get, and a lot of people get, end of the year bonuses and they just kind of assume, okay, we'll use that for Christmas, even if they don't know maybe how much they're going to be getting or anything like that. So they have a plan, but it's just kind of vague.
I mean, I think this is where we get into. I want to say it's Christmas Vacation, where the guy wants to buy a pool, or like his plans to buy a pool. Don't rely on variable things at the end of the year as part of your planning. I think it's better to treat those as extra and plan around the extra than it is to assume it will happen. Because the old expression about assuming, right, makes an ass out of you and me. Well, in this particular case, if we're thinking like, oh, I get a $5,000 bonus at the end of every year, they would never skip that. Bad years happen. Your performance, everybody listening to this, I'm sure you've all had a great year, and I'm sure you've all had a bad year when it comes to how you perform at work. We all like to think of ourselves as like A players all the time, but performance comes and goes, and we go through phases of life and so on. So I think on some level, it makes more sense to look at it and say, look, I need to be able to afford this out of my normal cash flow, my normal paycheck and income, and so on. And then if there is a bonus, terrific. Right. Maybe we can now do some last minute Roth IRA contributions or HSA contributions, or, hey, this is going to help us buy that trip to Mexico or whatever it is. But I think when you plan around variable compensation and bonuses, the mental accounting gets messy. A, because we don't have control over it, right? We can expect it, but we can't control it. And B, we tend to treat money for our paycheck differently than we treat bonuses from a standpoint of what it's usable for. And it's much better to do your planning where you sort of expect your expenses to happen in advance and you expect your income to happen in arrears, and that you plan for the worst case scenario that could happen between those two timelines.
Sure. I know if I get a bonus or something, it kind of feels like free money that wasn't in the budget, even if I was kind of budgeting around it. And I do tend more to spend it on something fun or an experience, which maybe I should have planned ahead for. I know last year for Christmas, I'll call up my sister in a positive way, but we had decided, oh, we're going to go to see the Nutcracker Ballet around Christmas. And then we waited to the last minute and tickets for like nosebleed seats were $500 a person. And we didn't go because we didn't plan ahead. And there's no way I'm paying that. So maybe we should have planned in several other ways as well.
Well, I mean, yes and no, because I think there's a slightly different moral to that story, which is yes, you should plan ahead and that should be in the budget, et cetera. And what happened here is that we did plan ahead. We just didn't plan ahead and execute all the way through, right? It's, a plan is only as good as its execution in reality. So in that particular context, the parallel here would have been we're going to buy the tickets anyway, assuming that I'm going to get a bonus, excuse me, that is going to make up for the difference. But you didn't have control over that. That's not necessarily what would have happened. So that's where I think we have to be very careful about that. Again, expenditures happen sort of in the present in advance. Things that happen in arrears, like our paychecks, like bonuses, et cetera, can be planned around, but probably shouldn't be relied upon.
Right. That was the flaw in our plan. Which leads me to our third.
You're just going to have to work harder and ensure that you get a bonus. That's the real secret here.
We're doing our best around here. Okay. Well, speaking of end of the year plans, our third point that I was going to ask you about is, use of time at the end of the holidays. People, it's a mix of you feel much, much busier this time of year with the holidays going on, but also in some ways you have more time, or at least we do here. We have some time off around the holidays. The office is closed for a certain amount of time. So I personally kind of struggle with what to do with that, how to balance it. Am I using this extra time that I have to further my development and work on stuff for myself, or should I be using it to relax, reset, and then come back after the break, theoretically stronger than ever? What do you do with that time?
So I think your experience this year is going to be a good contrast to your experience last year. Last year, you were not in a planning role, you didn't have client relationships, so you kind of really did get to take the time off at the end of the year. For me, conversely, as a business owner, I don't make plans during that time, so we don't see clients, don't take meetings, but I'm sort of on call, and you're going to have the same experience. You're sort of on call this year. In that particular context, the balance that arises is you want to make some plans. You know, hey, let's go have a breakfast with this person and a coffee with that person. Like make social plans like you would anyway. The balance to how you spend your time then is I tend to make use of that time as project time. Hey, you know, we'll have just done our retreat. You'll have given me your projection, and Greg and Daniel have given me their projections about what they're going to do in the coming year. So it gives me a little bit of time to sort of rework things and massage it into like, here's the plan of action for the coming year. It also becomes a time, just point blank, where I work on updating my slides for when I teach the retirement planning class up at CU. I have a little bit of a temptation to work on either a white paper or maybe a little bit of a book this break, but I think frankly I'm going to be too busy. But that's sort of my romantic notion is that I'm gonna come up with something creative during that time. But I think on some level it helps to sleep in, still go to the gym, work out, whatever, but don't get up at 6 and wake up on your own time, do some stuff, come back, work in your sweatpants, have some coffee. Like I think there's a healthy balance to just being sort of lackadaisically productive versus being like I've got stuff to do. I really got to get through all of this. Um, from a planning standpoint, just thinking about year end stuff, for our clients, right? We're trying to get really everything done really by this week or next week in most scenarios, a little bit that third week of December. But again, back to making sure stuff's done early enough that we have some runway in case something pops up. I think for anybody thinking about how they want to spend their own end of year and kind of what would your financial planner tell you to do, it really kind of falls back on the two conversations we just had. Things like last minute 401k contributions, Roth contributions, HSA funding, gifting. Gifting is a really big one. We have a lot of those conversations this time of year, and charitable donations. Those things sort of matter. But I think otherwise, it's a good time to sort of do a little bit of the mental work where you're not putting pen to paper or like creating a spreadsheet or something, but just sort of ideate and play with like, what do I really want to get done in the next year? And then I find, and I think my wife hates me for this, I end up spending probably about 4 or 5 hours the morning of New Year's Day almost every year, just like finalizing, saying, okay, I have the full 365 days in arrears. I'm going to document. I'm going to lay out my numbers. I'm going to calculate the year-end gain share bonus. I'm going to do all that stuff. And by noon on New Year's Day, I'm going to have a super clear, data-driven, spreadsheeted out, et cetera, vision of what we're doing for the next year. And I'm excited to show up to work the next day and start executing on it. That's how I approach it. I don't know that all of those takeaways or lessons or sort of perspectives are valid or useful for everybody listening, but that's how I approach it as a financial planner, as a business owner, and ostensibly as a person who has a personal life, but I don't know where that fits in exactly.
I mean, it definitely tracks with your personality. You are a very organized person. So that does not surprise me that your New Year's resolutions basically are scheduled and structured as of Jan 1. I
I
guess
mean,
it does probably help them get done faster and better.
it helps. Two things here, just to take and kind of put a pin in that particular part of it. One thing is that no plan survives contact with reality, right? Sort of the Mike Tyson, everybody has a plan until they get punched in the face sort of statement. Like I create projections for the year and I know they'll be wrong. Because that's just life, right? Something is going to happen that changes the course and the trajectory of things. So it is. By extension from that, the other thing to contemplate and in this, and because I sort of described a pretty productive, holiday break, quote unquote, in New Year's and whatnot, I love this shit. I love being a financial planner. I love being a firm owner. I love doing this. It is the most enjoyable thing I've done in my career. I enjoy it personally. I'd work 7 days a week if it was pragmatic and plausible, but it's not healthy and definitely not good for my marriage. But in that particular sense, this is something I really enjoy. And so in that spirit, it's rare that a day at work feels like a day at work to me. And from that standpoint, something like spending, my winter break ideating and pondering and thinking about it, and then having a big sort of work binge, half day on New Year's Day, like that's all super fun to me. If none of that sparks joy in you, please don't try to emulate me. It's fine.
I think a lot of people wish that they like their job as much as you do and probably will take more of a break. But What about people that aren't planners? There's people that have like their side hustles and these other things that they're trying to work on, their version of projects. Would you give the same advice to them to kind of do maybe half and half to be vague over their breaks? Or should they be kind of trying to lock in during that time? And
I think the only lock in thing that they should really seriously think about as they come to the end of the year is that, am I doing this next year? So you mentioned side hustles, and I think on some level, the mistake a lot of people make is they turn sort of a hobby into a business, and that itself is not the mistake. But the mistake is that they open the bank account and they start doing the bookkeeping and the tax compliance stuff, and they do it for a year or two, and then they let it sort of sit for a couple of years, and that just creates costs, both compliance costs, legal risks. It creates bookkeeping requirements and tax preparation requirements and all this. We have a client who reached out and said, hey, like, I've done some consulting on the side and I'm not sure if I'm going to do any next year. Should I keep my business open? And like, there's a legal question in there, but from a financial planning standpoint, in a perfect world, if you're not going to do your business next year, you'd close it up this year. You just go ahead and put a pin in it and shut down your business, close your books, and that way you'll do your reporting for this year, right, in the coming tax season. But you won't have created a problem for the 2026 tax season. So in that particular sense, I do think it makes sense for people who have these side hustles, hobbies, whatever, to do a little planning and be very serious about whether they're going to do the same, do more, do less, and to take some appropriate action before the end of the calendar year. Because if the business thing is happening on January 1st, still, if it still exists, we've created a compliance cost that goes all the way out until April of next year, the year following, right? So from 2024, if I've got something open on January 1st of 2025, I now have a problem that exists all the way until April of 2026. So there is a little bit of a meaningful project to be done around, hey, am I going to do more or less of this?
so it's even more important to sit down end of the year and plan things out the way that you do.
Somebody once told me that having a small business, whether it's like our business with multiple employees or it's just your own little business, but somebody once told me that having a small business is like having the neediest child on earth, because unlike your actual children, which you can but shouldn't neglect, right? Your small business, if you neglect it, there can be financial penalties, there can be criminal penalties, there's all sorts of stuff that can happen to you if you don't attend to its needs. And so even something like a tiny hobby business can become a compliance problem. Like, here's an example. If you own a business and you have not submitted your beneficial ownership information report to the FinCEN network, you have until the end of this year to get that done, or you are in deep financial trouble. And there's a whole array of like, well, what if it doesn't apply to me? What if I'm an exception? If you're listening to this podcast, you're almost certainly not an exception. So if that's something you haven't done, call your lawyer and talk to them about what you need to file and what needs to be done there. But that's a problem where somebody who has a hobby business is just tootling along and not taking care of it. And they could potentially be slapped with literally thousands of dollars in fines come 2025 if they have not done that filing. And a lot of people are just completely and blissfully unaware of it.
Right. And I think as the year goes on, we get closer and closer to the end, people check out more and more. It's hard enough to get people to engage both like client wise at this time of year and other personal dates I have with people, lunches, coffees, whatever. A lot of people are already punting into January, but for that specifically, you cannot. That has to be before December 31st.
Yep. And yeah, here's the thing. We all get into this. We talked about this, I think, in the last podcast. We get into this like holiday phase. We're like, well, I'm busy. I got a lot of stuff going on. I feel you. I'm busy, right? I'm taking a 7-day trip coming this Friday. The week after that, we're taking a 5-day trip. The week after that, it's Christmas. Like, time rushes on by. There's a lot of stuff going on this time of year, but when it comes to owning a business or taking care of your personal finances, there's some stuff that lives or dies by the calendar year, and you've got to pay attention to it, because if you don't, you are in deep shit. Pardon my French. I think in that particular context, then, yes, please let the holidays be the holidays. Enjoy time with your family, all of that. But treat it like saving early and saving often. You've got to do it first. Take care of the responsible things first. Don't let it dominate your life, but make sure you've tidied everything up before you really take off for the holidays and try to forget about it for a few days.
Very accurate and inspirational as always.
If that was inspirational, I am deeply concerned about what lights a fire under you.
We all just need reminders at the end of the year. I like hearing things over and over. It really sticks for me then about how you should do things. So,
Well, as you know, I can repeat myself a million times and never explain anything, so you're in the right place for that. But let me turn it back on you, Emily. What are your end of year plans? What are you going to do that's productive or educational and so on as you kind of think about how you're wrapping up your year?
I have a lot of books that I want to read that are finance related, most of them through you, but also trying to make sure that relationships stay connected through this time of year. As I said, a lot of other people are punting until January, which in some instances is totally fine. But I like to be pretty communicative with people in my life, both personal and work related. So I'm also trying to focus on continuing to connect with people as much as possible and not let things lay for too long, even though we all are very busy. I still try to prioritize that stuff because it is important to me. So, kind of a mixture of both of those things.
That's fair. I think the being mindful that you can be productive with that time, but also just saying like, hey, I'm going to put some of my personal things first, try staying connected with friends and so on. I think that's a really important piece. I think that's where you get into sort of the big rock time management thing. Make your friends first, right? Schedule that coffee, that breakfast, that happy hour, whatever it is, a couple weeks in advance. And if you want to do things like read finance books, why not do those around those things? Because it's easy to sort of get buried in the work productivity things. Case in point, me. But I think it actually is much more meaningful because sort of that old expression: the only people who remember how much time overtime you worked are your kids. Same thing about your social relationships. The only people who are going to remember all the finance books you read are going to be the friends you did or didn't keep those relationships alive with.
All right. And I definitely, in years past, have had a tendency to work a lot, way, 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 way more than I have maybe in this last year when I've had different roles and stuff. When I'm not the business owner anymore, you are. So I get technically usually weekends and evenings off. So it's been different.
You are welcome to get up at 3 a.m. and make French onion soup for the team if you are so inclined, but no pressure.
No, I'm tired of doing that. You're the boss now, and I'm more than happy with that.
All right. Well, now that I've given myself an appetite, I think it's probably a good place to wrap up. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.